Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Stock Market Crashes, Lessons from History. Behavioral Finance Insights. Investor psychology has a significant impact on market stability. Emotions like fear and greed can drive irrational decisions, causing market upheaval. Understanding this can help make more rational choices. Key behavioral lessons. Avoid herd mentality. Just because everyone is buying or selling a stock doesn't mean you should too. Think independently and make decisions based on research. Stay rational. Panic selling during a downturn often leads to losses. Staying calm and considering the long-term perspective can prevent hasty, regrettable decisions. Beware of overconfidence. Overestimating your knowledge can lead to risky investments. Always do your due diligence and accept that no investment is a sure thing. Understanding these lessons can help investors navigate future market uncertainties. Diversification, effective regulation, and rational decision-making are your best tools for weathering financial storms. Preparing for future market crashes. No one can predict the future, but there are steps you can take to prepare your investments for the next market crash. These tips will help you safeguard your financial future. Building a resilient portfolio. A well-constructed portfolio can weather market storms better than a poorly planned one. Think of your portfolio as a fortress. It needs strong walls and diverse defenses. Here's how to build a resilient portfolio. Diversify. Spread your investments across different sectors, asset classes, and geographical regions. This reduces the risk of losing everything at once. Quality stocks. Invest in companies with strong balance sheets and a history of steady earnings. These companies are like sturdy trees in a storm. They might bend, but they won't easily break. Bonds and alternatives. Include bonds and alternative investments like real estate or commodities. They often perform differently than stocks, providing balance to your portfolio. Staying informed, staying updated with economic news and market trends is crucial. Knowledge is power, and being informed can help you make better investment decisions. Here's how to stay informed. Follow trusted sources. Regularly read financial news from reputable sources like the Wall Street Journal, Bloomberg, or CNBC. Economic indicators. Keep an eye on key economic indicators such as GDP growth, unemployment rates, and inflation. These can signal changes in the economic environment. Market analysis. Follow market analysts and experts on platforms like LinkedIn or Twitter. They often share insights that can help you understand market movements. Long-term investment strategies. A long-term investment approach helps you ride out short-term market disruptions. Think of investing like gardening. Patience and care today can lead to a bountiful harvest tomorrow. Why focus on long-term strategies? Compounding returns. Over time, reinvested earnings grow exponentially. This compounding effect can significantly increase your wealth. Reduced risk. Long-term investments help you avoid the pitfalls of trying to time the market. History shows the market generally trends upward over the long run. Emotional stability. Long-term strategies reduce the stress of daily market fluctuations. You're less likely to panic sell during downturns, allowing your investments to recover. In summary, building a sturdy portfolio, staying informed, and committing to long-term investment strategies can prepare you for future market crashes. These steps not only protect your investments but also position you for growth when the market inevitably rebounds. Understanding the history of stock market crashes equips us with the tools to face future challenges. We've seen that diversification can protect against massive losses. Regulatory measures can stabilize markets and prevent reckless behaviors. Emotional discipline keeps panic at bay. By learning from past mistakes, we can build a more secure financial future. Facing market crashes with knowledge and preparation turns turmoil into opportunity. Stay informed. Diversify wisely. Keep a long-term focus. These steps will help you navigate market volatility with confidence. Studying the history of stock market crashes yields invaluable lessons that resonate through time. These tumultuous events serve as poignant reminders of the inherent volatility and unpredictability of financial markets. One of the most prominent lessons is the cyclical nature of market booms and busts. From the 1929 Wall Street crash to the dot-com bubble of the early 2000s and the global financial crisis of 2008, each crash has its unique catalysts but shares common threads of investor exuberance, speculative bubbles, and subsequent panic. Moreover, these crashes underscore the systemic risks within financial systems, highlighting vulnerabilities such as excessive leverage, inadequate regulation, and interconnected global markets. Governments and central banks often play pivotal roles in mitigating the fallout through interventions like stimulus packages, interest rate adjustments, and regulatory reforms. However, the effectiveness of these measures varies, and their long-term implications remain debated. On a psychological level, stock market crashes demonstrate the powerful influence of fear and greed on investor behavior. While fear drives panic selling and market downturns, greed fuels speculative bubbles that eventually burst. Understanding these emotional dynamics can help investors adopt a more balanced approach, focusing on long-term fundamentals rather than short-term gains or losses. From a historical perspective, crashes also teach us about the resilience of markets and economies. Despite the initial turmoil, recoveries have often followed, spurred by innovation, resilience, and adaptive strategies. Investors who weather the storm and remain steadfast in their investment principles have historically been rewarded in the subsequent upturns. Ultimately, the study of stock market crashes is not just about financial theory but about human behavior, institutional dynamics, and the broader socio-economic impacts. It underscores the importance of risk management, diversification, and a deep understanding of market fundamentals. By learning from history, investors and policymakers alike can strive to build more robust financial systems that are better prepared to navigate the inevitable cycles of boom and bust. Stock market crashes serve as pivotal events in economic history, offering profound lessons that transcend generations. These episodes highlight the fragile nature of investor sentiment and the interconnectedness of global financial systems. Each crash, from the Great Depression to the more recent COVID-19-induced downturn, presents unique circumstances yet shares fundamental characteristics that shape our understanding of risk and resilience in markets. One critical lesson is the role of speculation and irrational exuberance in driving market bubbles. The euphoria that precedes crashes often leads to inflated asset prices detached from underlying economic realities. The dot-com bubble of the late 1990s, fueled by extravagant optimism about internet companies, and the housing bubble of the mid-2000s, underscore this phenomenon. Such periods illustrate the dangers of herd mentality and the importance of prudent risk assessment in investment decisions. Moreover, stock market crashes expose vulnerabilities in financial regulations and institutional frameworks. The lack of oversight or ineffective regulatory mechanisms can exacerbate market volatility and amplify systemic risks. The aftermath of crashes often prompts regulatory reforms aimed at enhancing transparency, imposing stricter controls on leverage, and improving risk management practices. These reforms aim to prevent future crises and safeguard investor confidence. Additionally, crashes reveal the profound impact of global interconnectedness on market dynamics. The transmission of financial shocks across borders underscores the need for coordinated international responses and cooperation among central banks and regulatory authorities. The interconnected nature of modern financial markets necessitates a comprehensive understanding of cross-border implications and contagion effects during periods of market stress. Beyond financial implications, stock market crashes have profound socio-economic consequences. They can exacerbate inequality, erode consumer confidence, and strain public finances. The 2008 global financial crisis, for example, led to widespread job losses, housing foreclosures, and long-term economic stagnation in some regions. These events underscore the importance of inclusive economic policies and social safety nets to mitigate the adverse impacts of market downturns on vulnerable populations. In conclusion, the study of stock market crashes is essential for understanding the complexities of financial systems and human behavior. It emphasizes the need for resilience, prudent risk management, and a long-term perspective in both investment strategies and policymaking. By learning from history and implementing lessons drawn from past crises, societies can strive to build more resilient and equitable economic systems capable of withstanding future challenges. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.